I am John Shirley. Let's go ahead and get this thing started. I'm John Shirley. I'm the Vice President of the Vendor Marketplace. What I do is I bring vendors into the vendor marketplace to help you with your real estate investment needs. We do have presentations such as this to help you in your real estate investment journey. So my guest today is Ravi Kaku, and he's with Blink Lending. His class is the R that pays you back, mastering the refinance of the BRRRR, or in BRRRR. It's a method. So without going into detail on all of it, we're talking about the refinancing part of it. So Ravi, I'm going to step out. Actually, welcome.
Yeah, thank you. Thanks for having me on.
And
you're just going to leave me there for a second.
Absolutely. You're good. And I'm going to step away.
Awesome. Thanks everybody for joining. Again, my name is Ravi, and we are going to be talking about the R that pays you back in the BRRRR method, which is buy, rehab, rent, refinance, and then a repeat. I'm going to try to narrow it down more into the refinance part of this presentation, just because we've been seeing a lot of that this year, and of course that is the main method that is used. Yeah, this is just another title slide. Perfect. So to talk a little bit about me, first generation Indian American. As you can see, I put that picture there so you can see that I've outkicked my coverage with my wife, and then there's my 2-year-old there who looks nothing like me. I am 12 years into this. We are a direct hard money lender as well, so we're kind of a perfect fit for the BRRRR strategy as we do both sides of the loans. And I've done an estimate of 200 million in loan origination, and that's just to kind of show you that I've been doing this for a pretty long time. Next slide. Yeah. So this slide is to show, if I can just go back one slide to the Costco. Yeah, so this is, I kind of put this slide on here to, when everyone thinks about Blink Lending and investments, we want you guys to think about Costco because we're on the wholesale side for the long-term loans. So meaning 8 out of 10 times our rates will be lower than what you might see out there because we don't have a lot of overhead. The office behind me is our office. It's a small boutique office here in Houston. So what we do is when we don't have those costs that other companies may have to pay out, we pass those down as savings to clients. So that comes as lower rates and pretty much no lender fees. So 0 processing and 0 underwriting fees to you as an individual that works with us. But also when you go to Costco, there's a large amount of items that you can buy from there. And that's kind of relatable to us because you can get the hard money loan from us. You can get a conventional to purchase, to live in as your primary home. You can refinance your primary. You can buy an investment property. You can refinance. We also do loans that are, for self-employed borrowers, like bank statement loans, profit and loss. What we're going to talk about today is DSCR, debt service coverage ratio. So what we like to kind of think of ourselves as we're kind of a one place that has the ability to offer multiple different types of loans for any of that scenarios that you may have. So the biggest thing I'd like to start off with is the most important thing is kind of knowing what your acquisition power is. And this is the first conversation I have with any new clients, even previous clients, is to figure out what is your buying power? How many properties can you buy now? Now, are you doing this individually? As you can see, are you married? And then if you're buying it individually, separately from your spouse, so then you can, get 8, 9 homes under your name and then have your spouse come in to get 8, 9 homes under her name, to kind of leverage the amount of properties that you can own. How many properties can you buy in the next 12 months based on your assets, potentially even income to qualify? Do you have a sphere of influence you can tap into? Are there people around you that you kind of look to as mentorship that can potentially help you? Or let's just say you're a little short on assets or some kind of qualifying situation. Can you bring on a capital partner or a qualifying partner to help you acquire more properties? And then the biggest thing is you always want to be pre-approved with an investor-friendly lender. Not saying that there's anything wrong with any of the big banks or credit unions, things like that, but investor-friendly lenders typically are more in line and kind of know the goals that you're trying to accomplish as an investor because they've been working with them for years. So that's the biggest thing because they kind of know what different programs are available for you as an investor. The big thing that we talk to clients about as far as credit score, if you could hit the next 2, is when you're first getting started out in real estate, one of the main things that you would want to work on is getting your credit score up to the highest, possible score that you can get, because it does affect your financing, which also then affects your ability to cash flow, your qualifying as well. Now, these are a little bit older. They just made recently a change to where 780 and above is the best, but now they've broken it down to even by 20. So it used to be 740 to 780 were one category, but now it's 760 to 780 is one category. Now it's, and then it's 740 to 760, 720 to 700, things like that. Essentially, what the main point of the slide is that you are, if you do kind of have a lower credit score, the main thing to kind of work on prior is to try to help build that up. So then you do get that better pricing, because it could affect your interest rate by a point and a half, which can impact, your long-term cash flow on these properties. One update I want to share, but this has kind of been out there for about a couple of years now, is that when I first started in the industry, you were able to do a cash out refinance. This is Fannie Mae, Freddie Mac, so these are conventional loans. You were able to do a cash out refinance as long as you owned or were on title for 6 months. They've recently changed it, or a couple of years ago, to where now you have to be on title for 12 months. This can be very frustrating, because if you have a property, you rehabbed it, now the equity you built into it, the value is so much higher. Usually clients would like to take some cash out conventionally, but now you have to wait 12 months. Now, there are two caveats to this. If you were to buy the property cash, there is something called delayed financing, to where you can pull the money out up to your purchase price and closing cost of the cash purchase. You can take that money back out within 6 months, or we can always go the DSCR route, where you only have to wait 6 months on title to base it off the appraised value. So this is mainly about Fannie Mae, Freddie Mac rules that have changed. So knowing your financing options, so you as an investor client have multiple different ways of finding options for financing, right? Everyone knows about conventional financing, which I just talked about. This is the traditional loans, Fannie Mae, Freddie Mac, that you can purchase investment homes with. You have non-QM lending, which is what I'm going to kind of narrow down today, which is the DSCR type loan, or there's bank statement loans as well. You also have commercial lending, where you're trying to get a portfolio loan, different options with commercial. There's also private and hard money lending, which is what we also do, where you're trying to buy these distressed properties, rehabbing them. And the last option is you can always look into your phone. More than likely, you'll have people in your phone that you can present as a private lender to partner up with individuals and get financing through that way. So multiple different ways that you have options as an investor. That the biggest thing is finding the deal, but you'll always have the money. There's people always behind the scenes that will always have money ready to lend to you. Then it's just a matter of what's best for you. So yeah, today I'm going to talk about non-QM lending. Essentially, it's institutional money. These are private and public institutional funds. So you can think about like huge insurance companies that have money kind of sitting in escrow, that they, instead of having it sit there, they're lending that money out so it can earn interest until they have to use that money down the road. So there's alternative income qualifications, debt service coverage ratio loans. These are always going to range, 7 to 11%. You have options to go to 40-year fixed rates. You can also do interest only. There's no maximum finance properties that you can get with these type of loans. Now, there might be a max that you can get with one. Like, we are a broker, so I have multiple different approval departments that can go to acquire these type of loans, but these approval departments may have a max that they will only lend 5 loans to one individual. So when that happens, when we cap it with one approval department, now we just move it to a different one and then build that up to the max that they will lend. So that's, but truly there's no max. As long as we can find approval departments, they'll lend to you. You can close in an entity name. So if you are wanting to close in an LLC, this is possible with non-QM, with DSCR loans, whereas it's not allowed through conventional Fannie Mae, Freddie Mac. And you can potentially refinance up to 80% LTV. But again, usually these DSCR loans are going to come with prepayment penalties, and you can get them with 0 prepayment penalties, but they'll have either a range of 1 through 5. And of course, the longer the prepayment penalty is, potentially the better pricing you'll get. But of course, it's a step down prepayment penalty. So if you take I usually do 2-year, just because of where we are currently in the market, in the environment, to where if you pay off the loan in the first year, you have to pay a 2% penalty. And if you pay it off in the second year, it's a 1%. So it's just something to look out for, that when you're exploring options, you want to check what is a prepayment penalty. Because if your goal is to hold it and then sell it a year and 1 day later, you're going to want to get either a 0-year prepayment penalty or a 1-year prepayment, so then you don't get hit with that extra cost at the end. So yeah, today is going to be about the debt service coverage ratio. And the only reason I'm talking about this today is because I've been, out of the 12 years I've been a loan officer, I've been doing more DSCR refinances for investors like yourselves than I have in the past 12 years. This has become very, very popular because first, it's become a lot more approvable. Loans are, I think a lot of these approval departments have become more familiar with these type of loans. So now it's easier underwriting wise. There's a lot less documents needed. And a lot of clients are potentially holding the properties longer than a year. They're probably holding it 2-3 years, and they want to get out of the hard money loan. Whereas if you're self-employed or you've already maxed out on the conventional side, you can move on to the debt service coverage ratio. So the main formula with this compared to conventional loans is based on your personal income. So meaning your debt to income ratio based on your monthly income that you're bringing in on your paycheck, where this is strictly based on the property income. And this is the ratio to where you can kind of calculate it at home, where you have your net operating income. All that means is what is the rental lease agreement that you have in place, or what is the market rent for that property, and you divide it by the debt service, which in other words is your principal and interest mortgage payment plus taxes, insurance, and HOA. So the main thing is you want to have a ratio above 1, which just means you're cash flowing. So if your lease agreement is higher than your total debt service, meaning your total monthly payment, then you are positive cash flow, you're above 1%, and you get a lot better pricing. That's not to worry to where if you're not cash flowing, let's just say you're losing $50 a month, but you found it because it's a really good property, you think the appreciation is really great in the area, you're going to hold it for a couple of years. Even if you're not cash flowing on the property, this loan still works for you. We have options that even if you're not cash flowing, you can still refinance out of the hard money loan or just refinance in general to get into a long-term loan. So I wanted to kind of go through a couple of examples with you guys. Here's one where the rent is $23.50, and then what's included in that debt service. So you have your principal and interest payment, which is $12.64. Property taxes were $4.50 per month. Your homeowner's insurance is $125 a month, and there's no HOA. So your total payment for this home is $1839. So then when you take the $23.50, you divide it into $1839, your debt service coverage ratio is 1.28, which is incredible in today's market to have that ratio. But all that means is your cash flow positive, and you're going to get really good pricing because it is above that 1% ratio. Example 2, this is kind of on the other side where your lease is $1,300. Your payment is what, $890 or $938. Then you have $300 taxes, $80 insurance, you have $50 homeowner. So your total payment is $1,378. So when you take the $1,300 divided by $1,378, you can see that ratio is below 1. Again, that doesn't disqualify you for this type of loan. It's just you don't get as good of pricing if it was above 1, but you still have the ability to refinance out of it with this, even with a lower ratio. Because we could even go down to debt service coverage ratio where it's 0, meaning, you know, obviously that would never be the case where you're getting 0 rental income, but you could go as below, 1% all the way down to 0 to still refinance out. So wanted to go over a few case studies that we just recently went through to kind of give you a better idea of what clients are doing and what type of scenarios they're running into. So this client, this is for more of a purchase. So this would be if you were buying an investment property without rehabbing the loan, just going straight to turnkey ready. The client had a change in income, meaning he went from W-2 to being self-employed. So usually when you do that and you become self-employed, which I am, you have to wait 2 years of presenting tax returns, essentially having established 2 years of self-employed income to be able to use that kind of loan type of income for conventional financing. Whereas DSCR, that doesn't matter because it doesn't matter what your personal income is. So he was looking to purchase this as an investment property. Initially, he was approved at 20%, but he ended up having to put 25% down. The reason, so you'll see the purchase price $465. He had to end up putting 25% down. The reason why he ended up having to do that is you can see the monthly payment on the right-hand side. It was a 3-year prepayment penalty, but you'll see his total monthly PITI, meaning his principal, interest, tax, and insurance, came out to $2,694. But the appraisal on the market rent, so when the appraiser went out there to determine the value of the property, they also do a market rent analysis to determine what is the market rent for this property, and that ended up coming a little short of his monthly payment. So when that dipped below 1%, this DSCR program has you go from 20% to putting down 25% to kind of de-risk the deal in their mind when it's not cash flowing. But this is more on the purchase side. The next slide will give you guys more of a real life example on a refinance. So yes, this is kind of perfect with what mainly everybody might be looking for. So a client had a hard money loan that they needed to refinance, right? You want to get out of that high interest payment. The client borrowed the hard money loan at 70% of ARV, client self-employed, and the client also wanted to close in an LLC for extra protection in their mind, right? So the appraisal value came in at 240. The loan amount was initially he owed 168, but when you're doing it at 70%, you can typically refinance up to 80, but you get better pricing if you keep it at 75% or lower. So we were able to roll in all the closing costs. So the whole idea when you do the loan at 70% of ARV is we try to roll in all the closing costs into the loan to where you're bringing zero money to closing on the back end, on the refinance. The loan was initially disclosed at 1.07% DSCR ratio, meaning the market rent, what the client believed was a market rent or his lease agreement was higher than the payment. So the interest rate he ended up getting was a 7.25. He got a 2-year prepayment penalty. His total monthly payment on this property came out to 1817, and the market rent came in at 1950. And so the one thing I want to talk about the market rent is that even if you have a lease agreement in place, certain approval departments will look at the lower of the two, meaning what is your lease agreement if it's already tenant occupied. If it's not, you don't necessarily have to have the property rented out for this DSCR program if the ratio comes in above 1. So let me repeat that just to make that clear. So let's just say you rehab a property, you want to refinance it before you want to start the process before you get a tenant in there. If I order the appraisal and if that market rent in this scenario comes in at 1950 and your payments only at 1817, I can still refinance a loan without you having to have the property leased out. The only disadvantage of not having it leased out is if the appraiser came back at, let's just say 1800 and you're below that 1% ratio, then we would want to wait to where you get the property leased out. You could take a hit on the loan to value. So instead of refinancing at 75%, I would have to refinance you at 70% because they lower the loan to value when the property's not leased. So just know you have multiple options that you don't have to have the property leased out. It's in your best interest to do so because you can get better loan to value lending terms on the back end. So I kind of want to compare DSCR because the question always that clients ask is that how does DSCR compare to conventional financing? Nowadays, they've become very formidable in the sense that if you're cash flow positive, you'll see that it kind of comes out pretty much the same or even better sometimes. So these are two different charts. I'm not sure if you could see it, but the main thing is to show you with investment properties is what is the loan to value at 80% compared to being at 75% loan to value. If you're purchasing a home, putting 20% down, the interest rate is essentially almost 0.5% higher compared to if you were to put 25% down. So the extra 5% helps you drop your payment by about $200 a month, and to help you because you're going to be getting a lower interest rate. So it's an extra $15,000 out of pocket that goes to the equity of your home, and then you get to get a better rate and cash flow more. So then it just depends on what's more important to you. Is it to keep that extra 5% to then use that for the next deal? Or is it, hey, I'd rather cash flow or get better financing and I'll put that 5% down more on a conventional purchase? And this is for investment properties only, the rates that I'm showing you. This is today's pricing on DSCR loans. I just priced this out this morning. So let's just say your appraised value was 300,000, your credit score is 760. You're refinancing up to 75% and your ratio is above 1. This is priced at with a 2-year prepayment penalty. Again, the 2-year prepayment penalty is if you were to pay it off in the first year, you would get hit with the 2% of the loan amount as a penalty on the payoff. And then if you sell it in the second year, it's 1% of the loan balance. And of course, if you sell it after 2 years, there's no penalty at that point. And then the client had a lease agreement in place here. So you'll see that there's the first option's at 75%. Let me just make sure. Yeah, the first option's at 75%. So you'll see the interest rates if it's above 1% ratio. And this is even at a credit score of 760, to where if you had a 780 or above, they could get better. But you can go as low as 6.75 on a DSCR loan when the ratio is above 1 at 75%. Whereas the second chart is if you were to do it at 80%, meaning go above the 75% loan to value, the interest rate is just about a quarter difference. To go to 80%, and your payment changes about $150. The one thing I want to point out where it says lender fees, that's just the cost of the rate. Again, as I kind of mentioned at the beginning, we don't charge underwriting or processing fees. So the only time you'll see any cost in your origination is for the actual cost of the rate. So meaning the lower the rate that you want to go with, the higher the cost. It's kind of like a seesaw. The lower the rate, higher in cost for that rate. Whereas if you're okay with taking a higher rate and you want to pay less upfront, and you're worth taking the extra $50 extra higher payment, then you just got to see what is your break even point. So meaning if you're presented rates at, let's just say 6.25 on DSCR, and then you see in your loan origination that there's $8,000 in discount costs, underwriting, and processing, you just want to calculate, okay, is it worth going down to a 6.25 if my break even point is 4 years from now? Meaning, are you going to keep the property for 4 years? Because if you aren't, then it could be lost money when you sell the property or refinance again when the rates potentially may drop in the next year or two. So the biggest thing is to always evaluate when you're looking at different rate options is, what is my lowest rate and how much is it costing me compared to the highest rate, and how much does it cost me in the payment difference between the two. And you can kind of figure out when your break even point is, to where right now I would say anything less than 3 years, it could be worth buying it down. Anything more than that, it would be tough. But then it's more of your personal opinion as where do we see yourself in the market? Do you think the rates are going to be going down in the next couple of years? Or do you think, hey, this is the lowest it's going to be? I don't think the rates are going to go down anymore for the next 4 or 5 years. This chart is to show, it's supposed to be for a refinance, so a purchase price is supposed to say appraised value. And this is at the 75%. But the big key here is that it's less than 1% ratio, meaning the property is not cash flowing. Same credit score, same 2-year prepayment penalty, same lease agreement. You can see the interest rates kind of shoot up by about a point and a half when the property is not cash flowing. So the property can still get done, but the interest rate's going to be higher and it's going to cost a little bit more. So John, do you mind going to the previous slide just one time? So you can see in the first box to your left, the lowest rate you can get in this scenario when it's above 1 is 6.75, and it's going to cost you about $2,900 to get that rate. And then John, if you can go to the next slide, just to compare, if you go to option 1, like trying to get the lowest rate, 7.5 for the same amount of money. So for the same amount of money, you're getting a lot higher of a rate when that ratio falls below 1. But again, it's not necessarily a bad thing if that happens, because you can still get out of the hard money loan. And of course, if you think that appraised value right now, you bought the house for, 175, you put some money into it, now it's worth 300,000. Yeah, you might be losing a little bit on cash flow, but now you've gained all that equity. And then if you're a believer in that area to where, that appreciation can still occur, it's okay to be losing a little bit better, because this may be the highest payment you'll pay. Maybe in a year, 2 years from now, the interest rates drop a point to 2 points. Now you'll be able to refinance, get a better rate. Then you might be cash flowing at that time. And now you've just paid down your balance, and now the appreciation has also gone up during that time frame. So it's not necessarily a bad deal when it's not cash flowing. It's just, what is your individual goals for it? Just know that there's an option to get out of the hard money loan. Yeah, this is to show the biggest thing that for clients that I always talk to is to figure out, how much house you can afford. What is the best program for you, right? There is conventional loans that you can get pricing for, that you can go up to 9 properties under your name. That's based on your debt to income ratio. How much is your buying power? What is the max amount that you're looking to qualify? Maybe you just want to stay below 200,000. That's your max. Okay, great. Well, how much in assets do you have, to where how many of these houses can we buy, and what's the velocity? Can you buy 4 of them all in 1 month, or do you need to spread it out over the time? So the biggest thing is to always just have a conversation, whether it's me or any other lender, to be like, hey, what am I pre-approved for? And then how many loans can I do with you, or how many homes can I buy here, let's say in the next 6 months? Will I be doing conventional loans? Will I be doing DSCR? what is my exit strategy to get out of this, so I'm not being forced to either sell the property or into a bad deal at the end of the day, or stuck in a hard money loan for more than the 6-month term. You're in there for a year and a half. The big key for conventional loans, if in case you just didn't know, whether you're this is more for a purchase. If you're purchasing an investment property, just know that the lender can, when they get the appraisal done to determine the value of that investment home, they can also order a rental income analysis to also be done, to where they can use whatever the appraiser comes out with as far as a market rent for the area. That can be used to help offset your new mortgage payment for that investment property. So just know, when you're buying it, if you go straight conventional, you don't have to get hit with that full payment. They can use that future rental income for whatever it might be, and to help offset that mortgage payment, to help your buying power to increase, and to help you qualify for that mortgage as well. So get instantly pre-approved. We're really big on this. If you were to go to our website, there's a place where you can get instantly pre-approved. It's a formula-based system, to where you answer about 6-7 questions. Based on your answers, you can instantly get a pre-approval letter emailed to you. This is mainly to where, if you can't get a hold of me, or you can't get a hold of whichever lender you're working with, it's on nights, weekends, but you're talking to your mentor, you see a property that you really like and you want to put an offer in, you can use our website to get instantly pre-approved. So at least you can go move forward with at least putting in the offer, and then we could always help you with the financing, whether it's with us or with anyone. This is just to give you an avenue to get a pre-approval letter without having to wait, multiple days, hours, to get that letter to move forward with the offer. But that's pretty much it for me. Just want to kind of go briefly on that DSCR. This is the best way to get a hold of me. That is my direct cell phone number to reach me. It's my email address. I'm on Instagram and blinklending.com. We're really big on education. So if you were to go there and you were to click on the top link, we have calculators for DSCR. We have calculators for your hard money loans. We have a lot of research, a lot of blogs. So we have a lot of education on our website that you could go there, kind of explore the different kind of things that we have on there to kind of have you more informed about each program that we offer.
Okay, yeah, so folks, please go ahead and enter your questions in the box. Keep in mind that DSCR is the big sexy right now, is what a lot of people are doing. It doesn't fit everybody, so I would check out the website and look at and educate yourself on these, and ask Robbie questions too, find out which direction is best for you.
Right.
I've got a question for you. What is what's the smallest loan amount you'll lend on, as far as the size of the mortgage?
So if we're talking about on the long-term side, we typically have to be around 75,000 to 100,000 as far as a loan, because the things that we run into is high cost lending laws, meaning usually the lower the loan amount, the closing costs, like the third-party closing costs plus whatever the origination and cost of the interest rate, if it goes above a certain threshold, they have these laws in place to protect the borrower, to make sure they're not being overcharged for the loan. So when we typically see lower loan amounts, it's harder for us to get them done when we're regulated in this space, especially on the conventional side. DSCR, we have a little bit more, non-QM, sorry, we have a little bit more space to get them done. But I would say 75 to 100,000 is usually the sweet spot, and if you're talking about on the lower end of loan amounts.
Sure. Okay, makes sense. You want to be able to refinance out?
Yeah, exactly.
For the DSCR loan, how long is the pre-approval letter good for?
So typically DSCR, when we run your credit, the credit report's good for 3 months, 4 months. So as long as your credit hasn't expired, then that pre-approval stays active for you. So then it's just a matter of if you're closer to the end, just to get back with me, and we can rerun it, because it's a refresh every 90 days in general for your credit report.
Yeah. So
but if you're talking about on a refinance, the pre-approval really doesn't expire in a sense, because then at the end of the day, it's going to be based on the numbers of the property and how do the numbers look to see how can we refinance you out of. Now, if there's a drastic change in your credit score to where you thought you had a 740 and I run it and it comes out at 500, then yeah, it'd be tough to get done. But yeah, as far as like the pre-approval, it's it's kind of a fluid thing when you're talking about refinance.
Yeah, yeah. Just because you have a pre-approval letter doesn't mean you should go and finance something big in
Correct.
the
Yeah.
process. So
Yeah. And the advantage with DSCR, again, it's like there's no personal income and your personal liabilities don't really come into play because there's no debt to income ratio to qualify for. It's strictly based on the property income. So all that is kind of thrown aside. It's really, does a property cash flow or not? And that's all it's really qualified off of. Now, there's other caveats, of course, but you don't have to worry about your income or any major liabilities in that sense.
okay, very good. Is there such a thing as a DSCR HELOC?
I've never heard of that. There's DSCR, you can do a cash out refinance. You could even do delayed financing. I'm just closing one for a lifestyles client. Today he's going to closing to where he bought the property cash. A month ago, he decides to do that on his own and rehab it on his own. And had the ability to pull his purchase price, so how much he bought it for, plus closing cost at the time of his closing on the cash purchase. He was able to get that money right back out, and now he's going to use that to go buy more property. So yeah, no HELOC options, but you do have cash out options.
Very good. The now on the pre-approval, when they fill out pre-approval for that, is that a hard pull or is that a soft pull?
So typically we'll do a soft pull up front on the pre-approvals, but then we eventually, if you decide to move forward with us and you want to do the refinance, then we'll have to do a hard pull for actual underwriting.
Okay. Next question. Would I face any issues if I recently bought a home less than 6 months ago, or does it mainly depend on the purchase price of my investment property?
So could you repeat that question?
Would they face any issues if they had recently bought a property less than 6 months ago? Or does the DSCR mainly depend on the purchase price of my investment property?
Yeah, I mean, so if you're just refinancing the balance of your loan, meaning what's called a rate and term, meaning you're not doing any kind of cash out, there's no seasoning requirements to do so. Let's just say you buy a property, you rehab it in 2 weeks, and now you're ready to refinance. You don't have to wait any kind of 6 months or anything like that if you're just refinancing out of your hard money loan balance. So, but if the question is, if you bought another property and now you're buying another one, does that affect you? It doesn't, because in DSCR, the other properties, payments, they don't play a factor in that ratio. You do, if it's on your mortgage, you have to provide mortgage statements, but the payments they don't affect you. They're just making sure that you haven't been late on any mortgage payments.
Okay.
If that answers the question.
Yeah, I would think it would. If not, just ask me another question.
Yeah.
So the next question is, sorry if I missed this, but what is the minimum credit score you're looking for a DSCR?
So DSCR, especially if you're below 1% ratio, we can go as low as like 640. But you're going to be capped at certain loan to values. You won't be able to go up to 80%. You won't be able to go to 75%. You might be closer to like 65, 70%. But that's just with a few of my approval departments. We do have access to others, but then they have their own caveats. Like, right, some people will allow you to go to a lower credit score, but then they have a minimum loan amount of 150, where one company will let you go down to 100,000, but their minimum credit score is 660. So every scenario is just kind of different, because then it's like whether you cash flow or not. But typically, if you can be around 640 or above, you should be in the safe area to where you can find a way to get out of that loan.
Okay, well, that makes sense. I don't have any other questions.
Okay, awesome.
So, folks, if for whatever reason, if you come up with a question later, reach out to Ravi. His contact information is right there on the screen, and let him know what your questions are. If anything, check out their website. Whoop, here we go. Why would one choose DSCR over conventional?
Yeah, it's a great question. I always tell my clients, if you qualify conventional, go conventional, right? You pretty much will get better terms. But nowadays, like I kind of showed in the charts, DSCR rates could be better. So, but some of the reasons why, if you're self-employed and you write off a lot in your taxes, so you don't necessarily qualify for conventional loans, you would go DSCR because your personal income doesn't matter. If you've already maxed out your Fannie Mae, Freddie Mac conventional loans, you already have 9, 10 loans under your name, That's why you go DSCR. You want to be limited documentation through underwriting, meaning with DSCR, I just need an ID, 2 months of bank statements, and just your property's mortgage statement, taxes, and insurance. So it's a lot less underwriting to go through for DSCR. The other reason would be is if you want to close in an LLC. For some clients, they got the hard money loan in the LLC and they want to keep the refinance in the LLC. That would be the other reason why. But the biggest reason I see is for investors or self-employed clients that they don't want to either show their personal income or they don't want to qualify using personal income. They'd rather just qualify based on property income only. And the other reason is the cash out option, right? Some of these clients that have bought these properties and they're able to do a cash out refinance after 6 months compared to conventional where you have to wait a year. That's another reason why.
All right. Now, how long, what are we doing here? How long does it take to complete a DSCR cash out refinance from application to funding?
Yeah, so I just closed the one that I'm closing today. It took 14 business days to close. So right now it's depending on the approval department, and a lot of it is on the clients. Like I work very quickly. So if the client's working quickly with me, providing documents and everything, we can close these loans in a matter of 14 to 21 days. So a lot of times when I talk to clients, whether they've done the hard money loan or not with me, I always tell them when you're about 2 weeks out from the house being finished, let's go ahead and get started on the refinance process. Let's get everything in underwriting and just clear all that stuff up that they want in underwriting to where the only thing we're waiting on is for the appraisal to be done. Once that appraisal comes in and hopefully it meets value and everything, then we just turn right around and close the loan. So yeah, 14 to 20 days is our average right now.
All right. So are you able to do multifamily with a DSCR, maybe 25 units or smaller?
Yes, we can. It's not like in the 80-90% of the loans that we do have options to where it goes above the 4-unit properties that we have some options. Now, again, the more unique your scenario, it's different approval departments that we work with. So that 14 to 20 day time frame, I would, change that to a little bit longer when it's that kind of scenario, but it can be done.
Okay. Are the DSCR loan rates the same for duplex, triplex, quadplex as for houses?
No, they would be slightly higher, maybe 0.25% to 0.5%, depending on credit score, because the more units, the more risk that the banks look at it as. So it's going to be slightly different when you're going from single family to any kind of multifamily. For me, up to 4 units is considered residential. Anything after that, it would be like a commercial DSCR loan.
Yeah, that's what we teach as well. All right. So for non-taxable income, do you consider it the same as taxable income for debt coverage?
So again, taxable or non-taxable, like if they're talking about personal income, that none of that plays a factor with DSCR. It's strictly based on the property income only. So the one thing I didn't mention is like if you have when we do a DSCR loan, we do an appraisal to determine the value, and then the appraiser also lets us know what is the market rent. So even if you have a lease agreement in place, most of the approval departments will go off the lower of the two, meaning if your lease agreement is about $100 more than what the appraiser comes out with, a lot of approval departments are going to de-risk it or leverage their risk by going off the lower amount. So they'll use the market rent that comes on the appraisal. Now, if you have history of receiving that rent, there's exceptions that we can work with to where if you can show us a history of receiving that higher rent from your lease agreement, we can go with that if that helps us qualify for a better pricing. But yeah, non-taxable or taxable income, that only plays a factor with conventional loans, not DSCR.
If I go with a conventional loan as a W-2 employee, will lenders base it on my annual income, or do they evaluate investment properties different from personal residences?
So personal residence in the sense of primary home, or do they mean like personal residence as an investment property?
Yeah, I think they're personal residences. So, what Robbie's trying to tell you guys with the DSCR loan, it's not based on your income. It's based on the income the property is going to make.
Yeah, so the best way to look at it is conventional is based on your personal income, meaning your W-2, your pay stubs, whereas DSCR is based on property income, meaning just the market rent. your income doesn't play a factor at all in DSCR loans. Like I'm not even going
Right, and that's
to tax returns. I'm not going to ask for your W-2s on DSCR.
you cut out for a second there. So
But
yeah,
to help
and I
answer that
apologize
question
for
though, if they do want to go conventional to
go ahead. Okay.
Oh, sorry. Yeah. So if you were asking,
Yeah. So what happened was I read it and it processed in my head wrong. So I apologize for the person asking the question about the W-2 employee and doing a conventional loan. So yes, it is based on your annual income.
yeah, and it's gross income too. So it's before insurance, retirement, anything that's taken out. It's not your take home, what hits the bank account. It's prior to anything being taken away from your gross pay is what is qualified for conventional loans.
Is the cash out refi rolled into another DSCR or is it conventional?
So you can do either or. If you do a conventional cash out refinance, you have to wait 12 months of seasoning, but yeah, that would just be a conventional loan. Whereas if you can also do a cash out on DSCR and you only have to be on title for 6 months. So, but again, for investment properties, you can only take a max of 75% of the value of the home. So depending on where your numbers are, cash out may not necessarily make sense because those rates are going to be slightly higher than if you just do a no cash out refinance.
Yeah. Let's see here. I've got a question. They're going back into the multifamily thing. And they're asking if you can, well, before we go into that, I do want to let you guys know, Blink Lending's primary focus is single family. They can do multifamily, but it's not their bread and butter. So I'm going to ask the question, and
Sure.
Robbie can definitely answer it. But just know that you should probably also be talking to folks that specialize in multifamily loans as well, because they might be able to answer the questions quicker or better than Robbie can right away, or better get you a better deal because it's not their bread and butter. So anyway, I'll ask the question. If you can do a DSCR on a multifamily with the appraisal, will the appraisal be a residential appraisal or can it be appraised like a commercial loan by the NOI?
Yeah. Any kind of multifamily that I just recently did an appraisal for a duplex, let's just say it is a different appraisal that gets ordered. It's not a single family residence appraisal. It's based on a multifamily. So it's a slightly different appraisal on DSCR. But again, it is all based on the rental income. So it will be based on the net rental income of whatever that appraiser comes up with.
All right. Next one. I used a hard money loan, rehabbed, then did a conventional refi 4 months later. Does my 12-month seasoning term begin from the time I bought the property with hard money or from the time of the conventional loan?
Yeah, that's a great question. It's from when you bought the property originally with hard money. That's when you start owning the property. So that 12 months starts from there. The one thing just to look at is you can only get up to 75% of the value. So we could just work through the numbers to see if your house is appreciated or if you pay down your balance to where, let's just say if it's at 75% cash out and if you're getting 10,000 after closing costs, is it worth doing that for you by taking on a slightly higher rate? Or maybe you have maybe you did this a year ago where the rates were 8-9%. And now you're wanting to do a cash out refinance and you can take out, 25, 30,000 and drop your rate down to a 7.5. Yeah. Then, all day long, that makes sense.
All right. So what are the current rates for financing out of the hard money loan to a DSCR loan today?
So yeah, I don't know if you can go back in the presentation.
Yeah. Hang on here. Let's see. Give me a moment. Oh, went too far.
And as John's going through that, if anybody here is currently in a hard money loan, or if you're in a DSCR loan, anything above 8%, and if you want to you could shoot me an email with your scenario. All I just need is your appraisal value, your current loan balance, and estimated credit score. I can put together a chart for you exactly like this to present it. So this is today's pricing on a DSCR loan. Again, the qualifications are 760 credit score, the ratio is above 1, and it's a 2-year prepayment penalty. So the chart on the left is if you were to refinance up to 75%, whereas the second chart is if you were to refinance up to 80%, only as if your ratio is above 1. These are the current rates this was as of yesterday afternoon when I sent it over. And then if you go to the next page, John, or next slide, this is the pricing if your ratio is below 1, everything else stays the same at 75% loan to value. So you're going to see there is a difference in pricing when you're not cash flowing. The thing to kind of take out of this is you have the option to get out of it even if you're not cash flowing, meaning out of the hard money loan. Because again, you might be paying 12, 13, 14% hard money. This is obviously a lot better paying principal and interest compared to just interest only.
Yeah, I want to also point out that this is for 75% of the refinance, not 80. That's a
right.
That's an edit. Yours truly forgot.
No, it's okay. That's my fault for sending it over like that.
All right. Let's see. That, sir, that was our last question.
Awesome. Well, I appreciate it again for everyone for attending. Thanks again, John, for having me on. This is great. And
Absolutely.
Again, if anyone does have any specific scenarios they didn't get a chance to go over, if they just want to talk offline, my cell phone number is at the end of the slide and my email. Feel free to reach out to me directly, and I'm more than happy to help out.
Yep. And you can download that right now, or actually you can reach out to me, or you can email Robbie for it as well. So, and you'll find him on the vendor marketplace. Robbie, thank you very much for your presentation. And,
absolutely.
This will be posted on the portal shortly, and you guys have a good one. We'll see you next time. Thanks.
Thank you. Take care.